All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey, everybody, those of you that are just now joining us and those that are listening to the recording, this is the Investing Unscripted First Fridays live stream, or the recording of the live stream that we do on the first Friday of every month, usually, most of the time, sort of.
Except when we don't.
That's Jeff Santoro. He is the voice of the people, my good friend. How are you, buddy?
I'm great. I'm glad to be live streaming with you here on this beautiful Friday, my friend.
Yeah, what's going on down there in Jersey?
It's a beautiful day, a little windy, but
it's a lot windy up here north of Boston.
It was a lot windy yesterday. Now it's just a little windy. Yeah, I'm sure people want to hear weather reports, though.
Oh, of course. That's why you come to an investing podcast, is to listen to middle-aged dads talk about the weather.
Yeah.
All right, we got some familiar faces jumping in here in the chat. We've got Ken Taylor. We've got Eric DeVore jumping in. And Ken, I'm so glad you're here, because one of my favorite things to do is to provide individual, personalized investing advice. Ken's asking about margin. Ken's kidding. So am I. I refuse to answer that question, even in joking now, because I'm afraid somebody's going to sue me.
Yeah, no, it's smart. I'm going to sue you, actually.
I mean, well, we own a small business together. It was inevitable that one of us would sue the other.
Yeah,
it's going to happen. Simon's joining us too, evening from Berlin. Hello, Simon. It's so good to have you on. Jesse Merritt joining us says, afternoon, guys. Afternoon to you too as well, Jesse. I do want to point out that I'm wearing the Casual Friday wardrobe of champions, the Atlanta Braves World Series champion. Yes, I know that multiple teams have won a World Series since the last time the Braves did. But you know who one of those teams is not, Jeff?
Look, in most,
not the Mets.
In most Marches, I'm just going to take the joke and bow my head in sadness, because I'm expecting my team to be a disaster. But I actually have pretty high hopes for the Mets this year. They surprised me last year. I think they're actually going to be good, which means they will disappoint me.
That's it. You said it, buddy. You said it. Poor Ken complaining. We commonly talk about beverage choices and cocktails and beers and that sort of thing on our first Friday. Ken's pushing 3 months. I know Ken's had some health issues that's kept him running dry. Just don't get over to Scotland when you come off the meds and do something dumb, okay? Be careful. Take care of yourself. We want to see you back. Eric DeVore, don't tempt me. I will take off my shirt on a live stream. Yeah.
Simon brings up a good point. How many countries take place in the World Series?
The only one that matters.
Well, no, there's two. Canada could technically have a team in the World Series, but
like I said, the only one that matters.
Yeah.
I say this with sour grapes because it was those very Toronto Blue Jays that beat my Braves back in 93. No, that was the 93, 92.
No, they won in 91 and 92.
92. No, not 91. 91 was the Minnesota Twins.
Right. No, they were 92 and 93 then. They were 2 in a row, weren't they?
Yeah, they were 92 and 93. That's exactly right. So
right,
Simon, well played. I will say, Simon, that was well played.
Yeah.
Teo's joining us. Hello from Tijuana. Hola, thank you, buddy. It's always good to see your face. And by face, I mean the words that are your name in the chat here.
So we pivoted from just saying hello to people to talking about the weather to talking about baseball. So if anyone is still listening on the podcast after it gets posted, I'd be really surprised. We should probably pivot to why we're all here, to talk about things related to investing in stocks. So it's been a month in the markets since the last time we did one of these. There's been a lot that has gone.
The first Friday of February was 1 month before the first Friday of March.
Yeah, but it's been
Plus
a
or
month,
minus a week.
if you know what I mean, in terms of news.
It has been. It's been a lot. It's been like, it feels like a year and a month, to your point.
So where do you want to start? What should we kick off the conversation with?
So I do think it's the one that you put first on our outline, and that the NASDAQ, it's not just in bear territory. As we record this on March 7th, it's after the market is closed. It's down because screen shares always work really great for people listening to podcasts, but they work even better for people watching live streams. So this is for people watching the live stream. The NASDAQ composite is in bear market territory. It's fallen 10%. It is down 10% from its recent high, which is its all-time high. The NASDAQ 100, the QQQ, is the popular ETF that you can buy, is down over 9%. But the Dow and the S&P still down 6% for the S&P. The Dow, which is vastly underperformed more recently, is held up better. So you put this on here. I want to hear you first. What are your thoughts here?
Well, the interesting thing to me is, and this I think happens every time the market starts to hit a downturn, whether it ends up being the beginning of a long one or just a short one that ends, is it always feels like it should be the stocks in my portfolio should be cheaper than they actually are after what feels like it feels like it's been more red days than green days for a while now. And yesterday I was in my portfolio, my spreadsheet, kind of looking through what I own, looking if there was anything compelling to buy. And there were some changes, but then with a lot of them, I still came away saying to myself, still pretty expensive. But mentally, it feels like, I guess my brain was expecting massive discounts because that's just the psychology of when you go through a down stretch in the market. But in reality, the deals aren't as apparent as my brain was ready for them to be. So I have found some things to buy that I think were at more compelling prices than a month ago, but not where my head thought it would be. That was my first takeaway. I don't know if you feel similarly.
Yeah. So just kind of build on that a little bit. The first time I really saw this particular phrase was during the pandemic sell-off. That March sell-off is capitalists on the way up, socialists on the way down, and the other one is growth investors on the way up and value investors on the way down. We ride the momentum, and we just think about growth prospects a lot. I did a video on NVIDIA a month or two back, and the comments were before the big sell-off, and the comments were like over the top. Nobody's going to touch them. Nobody's going to come close. They're so far ahead of everybody. And then more recently, there's a whole lot more people making comments about valuation as the prices has come down, right? So, I do think it talks a lot about, recency bias. When the market's going up, like we just project that. It's like, okay, this is going to continue. And when we do go through these sell-offs, and I think like the trade desk is like an exemplary example of this, where if a business is growing and they're hitting guidance and their future guidance is always really good, and they just keep doing the thing really, really well, predictably, they do get pushed to these extreme valuations that are priced for that continued perfection. And then you don't live up to that. And all of a sudden, all of that confidence gets washed out, right? And it changes the view, and like the margin of expectation of like what we have to see to pay a certain premium gets a lot higher. And I think that's just kind of where we are. So what I've really tried to do is look through my portfolio and think about my favorite winners that still have a lot of potential there, and not get caught up too much with how much has the stock gone up in the past year or 2 years or whatever, and really think about just trying to put the price inside within the framework of, okay, thinking about today's valuation, and then think about when I might need to turn this stock into money, 5 plus, 10 plus years down the road, what is the likely case of them growing into that valuation and then outperforming with their ability to continue growing the business and cash flows and earnings or whatever metric gets applied to that particular business. And it just makes it a little bit easier to see that everything is still overvalued. I'm kidding. It just makes it easier to see, like Shopify, for example. This is a wonderful winner. And, the stock went through some tough times when they made the decision to go into the logistics business. It's a high capital business, low margin business, low return business. And the stock got hit. Management stayed focused on that. And then interest rates went up and they're like, holy shit, it's going to take us a ton more money at really high capital costs to get that money to grow this capital intensive business. The economics no longer work. We're getting out of this. And they did, and refocused on that core high margin, high return, super sticky business. Stock's done great. And then I look at the broader world and it's like, you know what? There's going to be a ton of merchants that still want and need something like Shopify, like that platform that they can run their business off in so many ways, do so many things for their business, that save them costs and time and let them actually run their business and not have to also be an accountant and be a tech expert and be a marketer, like all of those, various things that you can use the software for. There are different tools they provide. It's like, yeah, this business, sure, maybe it's expensive and maybe we go into recession and the next 6 months are brutal because the take rate revenue they get on transaction volume gets hit. But man, I look out 5 or 10 years from now and it's built to continue to be a successful business. So that's what I try to do, is just put it inside that box of like, okay, yeah, there's some stuff that's expensive, but there's some other stuff that I think is interesting.
Yeah, I've been trying to think of it as it's interesting. So the first company in my portfolio that reported was probably ASML maybe, and that was like the last week of January, which feels like so long ago at this point, because earnings season, depending on the companies you own, earnings season for any individual person can be almost 2 full months long. And so if I think back to where the market was late January, early February, before like we were really starting to see the sell-off that we're talking about today, if you think of a company's results as being frozen in time on that date, that's kind of where I'm trying to keep my head. So I'll just keep using ASML as an example, just because it's a company that reported early, right? So they had a good quarter. I know what I'm looking for. I know what I'm keeping track of. I know what the future risks are. I know where the semiconductor market is, because I read the earnings transcript and I know what they're projecting. And then I have to kind of just keep that in my head while I see the stock price potentially drop 5, 10, 15, 20%, depending on how bad the market might get, to remind myself that it's mostly the same business as it was when it reported at the end of January. Like, yes, if there's macro concerns that are driving the market down, those macro concerns might also impact the business. And then the other thing that I just think is interesting is, just generally about the market, you're hearing so many companies report guidance that is below analyst expectations, or saying things like, we're being conservative, we're being cautious, because they don't know, they can't see into the future with any clarity because of how much is changing and how quickly it's changing. Like we got a question in the chat about tariffs. We're going to talk about that next, but that impacts earnings, right? Like if every company is missing analysts' guidance projections because they're being more cautious because they don't have the clarity that they normally would have, then those stocks take a hit. And when all the stocks take a hit, then the market kind of falls, right? And it's just like self-fulfilling prophecy. So that's another thing I'm trying to keep in mind, that we may be just seeing more cautious management teams because it is a more uncertain time than maybe it usually is.
Yeah, and we're especially seeing that in businesses that are like on the front lines to the economy and also run thin profit margins and deal with a lot of imported goods, where the impact of tariffs could be the most kind of leveraged up. Like Best Buy, for example, like the stock got hit and their guidance was really soft and management was really cautious because, well, it's like they're the epitome of like discretionary goods. So much of what they sell is discretionary, and so much of it is imported.
Yep.
And retail electronics is very competitive, and they have a high operating. I mean, they're very efficient. They're very good at what they do, but within the framework of being a really good business, it is a higher operating expense business, right? So you kind of put all of those things together, and like there's greater downside for them because, well, if they have to eat margin in an environment to be price competitive because their customers are balking about stepping up to that, and again, a 20% tariff on something that Best Buy imports from China. If it's $1,000 laptop, that's not $200. It's the value, right? Not what they sell it for. It's what they're buying it for is what that tariff is on. So the impact at retail is going to be lower than the percentage wise that we are hearing. But yeah, when you're only getting a few percentage points of net profit and demand is down and your retail sales go down because traffic is down because consumers are pulling back because they're worried about spending and how much money they have, like those things really compound on those kinds of businesses, right? So I'm being mindful, like as part of the game plan, the way I'm thinking about it is, I don't see any deep value in a lot of those businesses that make sense. This isn't like a back the truck up kind of moment to buy those
No.
sorts of businesses at all. And they're the ones that, because their valuations aren't super attractive, I don't see a tremendous amount of upside to buying right now for 5 years from now. But I'm still doing some regular investing because this is the environment that they're in. There are some opportunities, and I'm not buying stocks based on like what's going to happen this year, right?
Yeah. And when I think about 2022, which is the bear market, I prefer to think back to because the one that happened in 2020 was so quick, so fast, right? It happened and then it was over. But when I think about 2022, the thing that I think I did well or correctly in hindsight was because at that time I was still a very regular stock buyer. Like I think at that point I was buying like whatever it was, every Wednesday or every Thursday, I forget now. Like, but I was just forcing myself to make a decision once a week that I ended up never having to worry about timing the bottom, right? I bought what I thought was the best thing for me to buy every week all the way down and then all the way back up as the market recovered. So I'm trying to stick to what I normally do, every couple of weeks, whenever I feel the urge and the money's there, I make a decision and I buy something, but I'm not trying to back up the truck because I don't know if it's going to get any worse or better. And I'm also not trying to, there's also nothing that's like so compelling because the market's not down that much. I mean, this is, if this is the beginning of a prolonged downturn, that's one thing, but this also could be, we could come back in a month and do this first Fridays and the market could be up, year to date. Who knows? It could go any direction. So
yeah. I do think there are, you go ahead and then I've got a couple things to talk. I feel like I just totally just cut you off.
No, I was going to pivot to the comments. So go ahead.
Okay. So actually I think we can do that because there was Simon says, what is the strategy? I do want to talk about
For tariffs.
Yeah. But it's not even just, I think, for tariffs, but for these sorts of environments broadly. And there's always reason to be concerned, right? The market's always going to climb a wall of worry. But this period does feel like we look around broadly and think about everything that's going on. And it feels like we're on the cusp of moving from, all right, so like the job report was okay. It wasn't bad. It was okay. There were some certain sectors that might show signs of weakness. I was talking to Toby Bordelon, our friend and colleague, earlier today about the jobs report. And one of the things that he pointed out is like looking at the different sectors where they break it up. The hospitality industry is not doing great. That's right. That's where some of the losses were. And that means that, well, people are traveling less and potentially eating out less. That means people have less discretionary spending. People are spending less discretionary. The experiential stuff that's been so great since like 2022 when we could travel and go out in public more broadly. Are we getting to a point where finally a lot of that just kind of pent up interest has started to normalize? or are people pulling back? Like, we don't know that for sure, right? We don't know that for sure. So it's one of those things where we can also see a lot of false signals if we look too closely. And if our bias is, yeah, this is the beginning of a recession, we're going to find things that convince us of that, right? So I think we have to be careful. But thinking, like, one thing that I have done as a strategy, thinking about high valuations broadly and looking for ways to not protect my portfolio per se, but ways to generate return, even as stocks go down, is things like selling covered calls. I want to encourage people to go back to listen to our show that we did with, why can't I remember Jeff's first name? Jeff Fisher. Thank you. We did with Jeff Fisher a couple months ago. I want to encourage people to go check that out. But one of the ways that you can use options is selling covered calls. And what I've done is I've got probably 10 or 15 stocks in my portfolio that I own 100 shares or more of, that I've decided, after doing some research and looking at the options market for these individual stocks, that I can sell options 6 months to a year out, and at a strike price that, if I'm forced to sell at that strike price, I would be happy to take that. And if I don't, I'm going to earn a premium from that sold call. So,
and to be clear, just those are companies that you would be okay holding on to should things go sideways, and you keep the shares, but they're also shares that you're okay to let go of should they get called away.
Hey everybody, we'll be right back, but first a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally, but beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another podcast you need to add to your listening rotation. My name is Brett, one of the hosts of the show, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode. That's the Chit Chat Stocks podcast.
Yeah. So if we continue to see the bull run, like some stocks that the strike price that I sold at is like 40% higher than today's price, and within a year. And to me, for those particular businesses, that would be a sign of something exuberant with the market that I would be. And this is inside a retirement account too, so there's no tax implications of realizing gains. So I'm not concerned about that, right? So, like, it would be substantial profits for businesses that I still like a lot, but I'm willing to take on that risk of being called away. But part of my thought process is that if we continue to see the market decline or just below average returns because of the weight of concerns about the economy, potentially economic things happening that hurt company earnings that weigh on the stock price, depending on the stock, I'm getting anywhere from 7 to 20% premium versus the stock price that from what I've sold at in premium that I would earn. That's, I don't want to say it's free money because I'm creating risk in my portfolio to do it. So if these stocks do go down or just don't move up to that strike price, it's just additional earnings that I'm able to generate. And the same side, go ahead.
I was going to say, there's also, if the market really does sell off and you're looking for more cash to deploy, there's a little bit of an opportunity loss potentially, because you have to have that money is locked up in those 100 share lots, right? So, you have to be careful about how much you do. If someone wants to do this, they have to be careful about.
Well, no, with covered calls, no, I get the cash.
No, I know. But what I'm saying is, if you add up the dollar amount of all those 100 share lots that you have,
Right.
Because you have the calls written on them, or sold against them, that is money you could have been deploying into your favorite stock that is now 30%, 40%, 50% cheaper, right? So
right.
I just want to point out that.
So yeah,
it does sound like easy money, but there are things.
Yeah,
you have to
no, it
consider.
is. Again, the key is that I'm doing this on stocks that my intention is to continue to hold. But at the premiums that I've agreed to, if they get called away, I'm willing. I mean, it's a high quality problem if that were to happen. But if the stocks do fall, I would intend to hold them. So I'm not buying 100 shares of companies that I'm not interested in being an owner of, simply to try to earn that premium on. Because to your point, then I would be tying up capital in businesses that I'm not really interested in owning. And I don't have any interest in doing that whatsoever. So, yeah. At the same time, there's another strategy that I'm using with options for some of these expensive stocks to give myself some earnings and the potential to buy those stocks. So I'm selling puts. So difference between selling puts versus selling calls is when I'm selling calls, I'm getting paid and giving somebody else the right to buy the stock from me at a price. When I sell a put, I'm getting money, I'm getting paid to give somebody else the right to make me buy shares at a set price. I've used this for the trade desk to buy puts. I think I sold puts at an $80 strike, but I got paid like $14 or $15, which means that like today the stock is trading in the 70s, Jeff, which is 80 is more than that, right? So if those puts,
the math checks out. You're right.
Math checks out. Okay, good.
Yeah.
So if those puts expired today, somebody else could make me pay $80 for a $75 stock, but I've already earned in premium like $14. So my break-even cost for that $80 stock is $66, right? So it's created, and these puts are a year, maybe 2 years out. They're really far out. That give me the potential to, if things don't go well with the stock, it's a massive amount of margin of safety in the price over the next couple of years for a business like the trade desk. And, the worst case scenario is there's massive fraud and it's a zero, right? And I have to pay $80 for a stock that's worth $0. But the more probable worst case scenario is they just have really screwed things up. They've lost their edge on innovation. There's other products out there that do a better job of informing these big spenders where to spend to get the best ad return. And they've lost their edge, and I end up buying a not great business at a not great price, right?
Yeah.
I think it's more likely that I just get my premium and the shares are, well above $80 a share, and that's the money that I make. So that's part of my game plan in these uncertain environments, and uncertain environments where a lot of stocks are still expensive, where I can still generate some income and return in my portfolio whilst not having to do risky stuff like move into cash or, other things where you're upending the apple cart of long-term returns that stocks are, that's where they create value.
Yeah. And this is the time, this is also not the time to make any big changes or decisions in a portfolio, I think, right? You don't, because there's emotions tied to the market going down, even if it's just for a month.
Yeah, that's exactly right. So Teo had to say goodbye a few minutes ago. Teo says, I got to go eat some tacos, going to check out the recording. Teo, I hope the tacos were delicious.
Yeah, I respect that. I would leave this live stream if I had the option of going to get tacos. So I get it.
Yeah, I mean, I'd leave it if I didn't have the option to go get tacos, but
So Simon, the comment that we were just answering, I took it a different way. He said, I feel like the boy who cries tariffs is really upsetting the market. What's the strategy? If you're asking what the president's strategy is, I don't know. And I've yet to find someone who can explain it to me. So that's all I'll say about that.
The CEO of Ford Motor Company. Wait, I thought you were talking about Elon Musk.
Yeah, it could be anybody.
Yeah.
Eric had a good comment. It's almost comical with those comments, talking about the YouTube references, YouTube comments on your NVIDIA video. No one's going to touch on blah, blah, blah. That's about a 99.9% close to a top signal. Yeah, you see more of that when the market is frothy for sure.
So I want to say this though, and his wording was perfect, close to a top, not close to the top, right?
Yeah.
That's the thing to remember.
Okay. See what else we got in here.
I feel like John Gallegos is following us around.
Yeah. John likes to troll me about Outset Medical.
As he should.
All right, here's a fun game for everyone listening right now, because I played this with Jason the other day offline, and he got it pretty close. I want our viewers to guess in the chat. Put it in the chat. What is the current market value in total dollars of my Outset Medical position? Let's see if anyone can get anywhere close. If I sold it today,
do we want to give him like a how many digits it is?
I'm going to give no reference and just see if anyone can come close.
Okay.
Just because it'll be funny. Got here. LDP's got a comment.
Eric
98 cents.
Coming in with
Eric, you're not far off. So here's LDP had a comment about options. Now, I don't want to spend much more time on this. I want to move on, but I think this is a good thing to maybe answer. Selling puts.
LDP, great to have you here, by the way. Thank you for joining us here.
He says selling puts, in my opinion, only if you are planning on buying that stock anyway, because it is locking up cash. What do you think about that?
Yeah, no, that's true. Well, so in a retirement account, you have to use cash to cover those puts, right? So it does tie up cash. You can use margin. Again, I refuse to talk about what is a reasonable amount of margin use, but in taxable accounts, you can use margin, and it doesn't actually, until something happens, you don't actually have margin tied up if you don't have the cash to do it. So that's true. And here's how I've been thinking about this. I'm glad LDP brought this up, because I've talked about it before. I don't remember if I've talked about it on the podcast in a while, but so my goal is to have about 10% unlevered cash, unfettered cash in my portfolio that I can use. So we're close to that 10% for the NASDAQ. I don't use the NASDAQ 100, the decline. I use the S&P 500. We get to 10% down. I'm going to probably take 2.5% percentage points of my cash. If we see the S&P get to a 10% decline, I'm going to take about a quarter of my cash. That's a rule for me. It's close to a rule as I have. I'm going to go take that cash and I'm going to go put it to work. My actual cash in my portfolio is closer to 20% because I have used a substantial amount of cash for puts, selling puts in the past 6 months or so, because we've seen the market continue to march higher and higher. And there's a ton of companies out there that I would love to have either a larger ownership than I already do, or I would like to add to my portfolio that the valuation hasn't made sense.
Right.
Or like in the case of Trade Desk, I want to see them answer some of these questions that Jeff Green talked. Jesus, listen to me. That Jeff Green talked about on the earnings call.
This weird block of not remembering the last names of people named Jeff.
It's ridiculous, right? And I knew it was Green, but hey, I have a room in my life for one Jeff, and you are it.
Thank you,
Santoro.
I feel good about that.
So, but my point is that in the case of, I either have questions I want to see answered to support the valuation, or I don't think the valuation makes sense, and I'm using puts as a way to either get the stock at that lower price, or just at least I'll generate some return on that cash. And oh, by the way, I'm getting 4% yield on that cash. So 4% yield on the cash plus the premium on the put, if that's all I get, just about across the board for every single stock that I've sold puts on, would work out to double-digit returns on that cash being held up. Last I checked, that's better than the stock market's long-term average. I'll take that. I will absolutely take that. So even if there's some opportunity cost, if we do see another 20+% year for the stock market, I don't have to have 20% plus. If with this cash, if I can capture, better than the market's average long-term on that cash, and still not get the stock, I'm okay having it tied up.
All right. So I'm going to throw another question out to the listeners. And then I'm going to pivot to a different topic, because I think they're tied to each other. So about a month or two ago, maybe it was 3 months ago at this point, we did a bonus episode of the podcast called Stocks Unscripted, where we picked a stock. We did not plan ahead of time what we were going to talk about. We just had a unscripted conversation about that stock. And the stock we chose at the time was Costco.
Yeah. We have a framework of questions that we'll go through to kind of have some like parameters, but yeah, we're just rolling with it.
So the question for listeners, and by the way, this is for the ones watching live now, but also anyone listening later who can just reach out to us. We want to do it again sometime in March. So we're curious, what stock would you like us to unscriptedly talk about?
I love that.
But also, I bought Costco recently, which brings me to my next question I want to ask you. What's the most recent stock that you bought? And let's talk about that. So for me, it's Costco. What about you?
I don't know. Let me think about it.
Wait, let me frame it this way. What's the new? Have you bought anything new recently? Like first time in the portfolio?
Yeah. BBB Foods. It's pretty new.
What is that?
We'll talk about it on the next episode of Stocks Unscripted. It's pretty good, right? Pretty good. Yeah, pretty good. We've gotten some more rolling in on Outset Medical. We've got some more guesses coming in. Keep those guesses coming in. I want to say this though. So we've asked a question for viewers of the live stream to answer. Put that stock in here. So Eric DeVos put in Lyft, LDP's put in Brookfield Renewable. Love it. Keep them coming in. How do people that are listening to the recording, how they get questions? What's the first thing they do to give us an
anyone
answer?
who's listening to this later and is not watching live, you can get us a question in multiple ways, but they all start with step one is to go to both Spotify and Apple Podcasts and give us a 5-star rating.
5-star rating.
That's
first. Just do that first.
Step one.
Yeah.
Step two is to go to Apple Podcasts and give us a review, preferably positive. But honestly, if you give a 5-star rating, I don't care what you say in the review. And then the third thing is just ask us your question. But
right, which you can email us. You can ask
email
it
us,
on
social
Spotify.
media, whatever. Yeah.
You can DM us in any of our socials. You can email us.
It's important to give us that 5-star rating first.
Yeah.
That
Simon's put in here. KD is another stock. So those are good. I want to answer Jen's question about these long dated options that I'm doing. Part of it, Jen, so with the trade desk, for instance, I want time. I want time to really think through this. And the yield on the premium was really attractive for those 2-year puts. Mostly I'm doing 6 or 12 months roughly is generally what I'm doing. I'm trying to not do shorter ones. Frankly, it's a work related thing. I get paid to talk about stocks and to write about stocks. And if I transact on a stock, I can't talk about it for 2 market days before or 2 market days after, which basically means I lose a week to be able to monetize talking or writing about that particular stock. So if I do more velocity of options, it makes it harder for me to do my job. So that's one reason. The bigger reason though is that I'm just, for some of these stocks that I want to add to my portfolio, going with these longer terms, I'm happy with the yield. I'm happy with the total return I could get on the cash being tied up with the puts, and a few that I want to get some answers on. So that's it.
Makes sense.
It's also, this is more of a secondary strategy for me too. For people that are using options more for income and they want to increase the amount of income they can generate, shorter data puts do make more sense, because if you think about you stretch it out over a year with one particular stock and you're writing weeklies, and even if you're writing, weeklies only a couple a month, the total yield that you can possibly get and the total return can be substantial. It really can. It's also a lot of work.
Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures in podcast description.
So,
Okay.
I want to talk about Costco because anyone who's been waiting to buy it or wanting to add to the position after maybe a dip, you can thank me, because after having Costco on my top of my buy list for probably a year and a half, I finally decided, let me just buy some shares, like a very few, because I still think it's very, very expensive. Just so it's in my portfolio, I start to pay attention to it. And as of last time I looked about an hour ago, the position I opened a few weeks ago is now down 11%. So you're welcome, everybody. But I wanted to talk about it because I think I felt like for me, it was like a step where I had to get over this. I had to get over the way I was feeling about it. And we talked about it in that episode we recorded. It's always an expensive stock. It trades, I think it's reasonable to buy it for 30 times earnings, 35 times earnings, but it has been hovering closer to 60 for a while now. And that's around where it was when I bought it. But a couple things, I think it's not as expensive as it looks when you just look at the metrics that are out there, for a couple reasons. Like they just raised prices back in September, right? So like that has not really fully come through the financial statements. Like that'll be a little bit of a boost. Jim Gillies has mentioned on several occasions where I've heard him talk about Costco, how they own a lot of their land and buildings. And if they ever wanted to do sell that and do a lease back, that would just generate, a ton of value that isn't really reflected in the valuation. So I still think it's expensive, but maybe not as bad as it looks. And I also just wanted to have it so I would watch it and keep track of it. And I will add to it as it becomes cheaper over time. Like I said, it's down 11% after the last couple of weeks since I bought it. I don't think it's 11% less of a business. So anyway, I just thought it would be interesting to talk about, because it was one where I had to sort of like think through my framework for making a decision that was counter to the way I normally invest.
Yeah.
But I'm glad I have it in my portfolio now.
Well, I'll say this about Costco at this price. I don't think investors that buy Costco at this valuation and a hold for the long term are going to lose money. I think.
No, but I might not be the market with these shares.
No, that's the thing, right? You're probably going to get below average returns, but that's the case when you buy really big profitable companies that are growing at slow rates and you pay a high valuation. You're probably still going to make money, but it's going to weigh on your performance. But I've advocated for exactly what you're doing here, and that's get a starter position in your portfolio, and you're far more likely to see opportunities to add if and when the market does give them to you. So we need to talk about the portfolio contest. Before we do that, though, I do want to add one more thing on the situation I have with options too. I'm counting it up right now, and 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. I have options contracts on 22 separate stocks. That would be impossible to manage, not doing it just about full time, if I was trying to do monthly or weeklies. So that's another part of the reason I kick a lot of these out, is every month I take a look at a basket of stocks in my portfolio. I'll look for contracts that have expired, look at premiums, look at dates, and then make some decisions on what I want to do.
Yeah, makes sense. So keep the ideas coming for a Stocks Unscripted episode as we're talking here. If anyone else has more ideas to put in live. So I'm curious. I'm trying to find out where we should go next. So you added some
contest.
Yeah, let's talk about oh, that's right. You mentioned you wanted to talk about that.
Yeah.
So, man, it is a lot of stocks this time. As I went to look at the portfolio today, I was like, geez, this is a huge contest. But it's interesting how quickly things change. The last time I logged in and looked at it, I was doing all right. Now I'm down because of the last couple of weeks. So if anyone's new to this or checking out the podcast for the first time, in any of our show links, you can get a link to a Google Sheet that has this contest we're running. It is a combination of people who've been on the show. It's a combination of audience members. They could submit stocks to a portfolio, any amount that they wanted. We left it pretty open this year. I believe we said, and this will answer a question in the chat, you get 2 trades per quarter, I think we said.
Yeah, and we haven't ruled on this, but I will allow. I think we should allow that those can carry over.
Ooh,
So
like you can build them up.
Yeah, you get 8 for the year, 2 each quarter, and you can roll them forward. It's like rollover minutes. Remember when you actually could only buy a certain amount of minutes for your?
I just like that we're just making rules up as we go. I like that.
Well, bro, it's our
it's our contest. Yeah, we can do what we want.
Yeah. So far, Eric DeVore has shared 37 stock ideas, and we have 4 or 5 other ideas from other people. So
yeah,
keep them coming, everybody. You too, Eric. You can keep sending us ideas. That's fine.
I don't think I have any deep insights on the contest. I mean, what's interesting is there was one audience member, Caleb, who decided to do a portfolio that was all one stock. And that stock is Upstart. And for a while, that was looking like a brilliant strategy. There was a point at which he was winning the contest by a large amount. Unfortunately, that is no longer the case. And I think we'll see how this goes over time, but that's the downside of having a one stock portfolio. But yeah, I think it's worth checking out. You are currently beating me, Jason. Your portfolio is down only 1.4%, while mine is down 4%. But we are both beating Tyler. So that's good. That's good. That makes me happy.
So I'm not seeing a link in the, I'm not seeing it in the folder here. Do me a favor, message me the link in the chat here in the thing, because I'd like to be able to look at it too and see if I have some insights.
You're not allowed to look at it.
Yeah, fair. Oh, you know what? Never mind. I have it right here on our outline. I apologize. Yeah. Fair. It's all fair. Everything you're thinking right now, it's all fair. But it's not a good look. I will say this. It's not a good look that my portfolio was down again 2 years in a row. It's totally expected that yours is going to be down, but
yeah, that's fair.
Yeah,
that's fair.
Yeah.
All right. I want to pivot. I want to talk about something else. You put on our outline here for discussion today. You just wrote, I did a thing.
I did.
And I want to know what the thing is. I think everyone wants to know what the thing is. What did you do, Jason? What did you do?
So I did 2 things. And this ties back to the question. Holy cow, Eric, you're killing me here in the chat, buddy. Love you. Keep it going. But it gets back to the question. I believe it was Simon was asking, thinking about game plan. And this is kind of part of my process. Is one of the things that I've done. I did it today. So again, my trading restrictions communication carries over. Anytime I'm in a public forum, I can't talk about it, but I did something that I haven't done in a while, and that was go back and pull some leads. So there were 3 stocks that I sold today, 4 stocks actually, that I sold today that it's probably overdue. One of those 4 is still up, but it's up because I bought it a long time ago, and it's managed to hold up a little bit. But it's a business that I like the industry that it's in, but it's just really struggled, and I don't see a path to market outperformance going forward for the business. So I finally moved on. There was an international stock that gave me some exposure to India, which is a growing dynamic economy, but the economic model of the business and its scalability just wasn't delivering. So after holding it for 7 years, I finally sold. It was a tech startup that might go bankrupt, held too long. That's one that I will admittedly say I should have sold a year ago when I didn't see a path forward for commercial success, and I didn't. And it was down 90% then. It's down another 90% from that price. So the old question is, it can't go down much more. Is, yeah, it can go down another 100% from where it is today, was resoundingly answered there. And then there was another business that I just wanted to believe. It's a platform kind of business that there is super sticky. There's a lot of things about it, but it just feels like the market's a lot smaller and the economic opportunity and their ability to leverage and monetize the platforms never developed. So I decided in this environment of uncertainty, I was better off with that cash to be able to deploy into better ideas. So I made that move.
So it's interesting because I know we won't spend too much time on it because when you can't talk about the actual companies, it makes it a little less interesting. But what was striking to me was it got me thinking about if there's any weeds I'd want to pull in my portfolio. And I felt kind of happy that I was at a point where there's nothing I want to sell right now in my portfolio. That's not true. There is one stock I want to sell, but I actually am holding on to it because I don't want to take the loss on it. And I feel like I think it can come back. I really do. But I don't want to be an owner of this business anymore. Like, so it's not really like the results. It's more like, I just don't want to own the company. And so much of what I sold over the past couple of years was more that than anything. It was more like I'd start reading the results when it reported and just be like, I don't care. I don't care about this. I don't want to read this anymore. And that was a sign to me that, like, for the way I invest, I need to part ways with that company. But I don't have I have losers in my portfolio. And by the way, still, if you have an idea of how much my market value of Outset Medical is, keep putting them in the chat. I'll reveal before we log off here. Like, that's an example of a stock that's down massively for me, but I don't want to sell it. It's a lesson I'm trying to learn. So I'm going to keep it in my portfolio forever. Never going to sell it. But that's kind of where I am, even with my losers. Like, they're not substantial amounts of money in my investing life, where, like, to your point, if I sold all my losers right now, it's not a world changing amount of cash. So it's more fun for me to sort of just leave them and see how they do over time. I think it'd be fun to own a stock for 12, 15, 20 years that was a loser and just kind of see what happens with it. So I feel good about my level of weeds. I don't think there's anything I want to pull right now. Doesn't mean I won't sell something. If there's something that I'm not thinking of right now that's in my portfolio where, like, I really do think the thesis changes or gets busted,
Right.
and it is a larger part, one of my larger positions gets a busted thesis, I will sell. But just the ones that are particularly have done particularly bad in my portfolio they're not on my list of things to cut right now. I don't know. I'm in a weird place when it comes to that.
Yeah, no, that makes sense. That makes sense. It really does. And as somebody that's been buying individual stocks for more than 15 years, it is remarkable when you see what in hindsight was a really small sum of money turn into something that is like, I could buy a car with that money now. And of course you kick yourself and it's like, well, why didn't I put, like, twice as much small amount of money and I could buy 2 cars, right? It's
Well,
like,
that's how I am with NVIDIA, right? I think it's like, it's like less than $1,000 by cost basis in my portfolio, and it's up, I don't know, now it's only up like 300 and something percent. But all right, we had a question in the chat I think is actually a fun one to kick around for a few minutes.
Can you actually find questions amidst all of Eric DeVore's tickers ideas?
Yeah, I had to scroll for about 20 minutes, but I got to one. All right,
I don't know why you're asking me about my body hair grooming, Eric. I'm not going to take that bait. Just want to say that.
I'm going to move on from that. LDP asks, interesting topic is where you start with investing from scratch. Do you look for the biggest companies in market cap or specific industries? Mine is industries, energy stocks, and medical due to AI. So that's a good, I don't know. How do you start from scratch? It's hard because I think for us, it's hard because we can't avoid having new ideas put in front of us just by virtue of the work we do. So, like, I don't find myself having to go out and find new ideas, like, between the work we do, both for the Motley Fool and the fact that we have this podcast and the fact that, I get a steady stream of obscure ideas from subscribing to Tyler Crow's Misfit Alpha newsletter. But I'm trying to think, like, before that, how would I find new ideas? I don't look at industry necessarily. I don't look at market cap for sure, unless I'm looking small. Like, I might do a screener for, companies under 2 billion or something if I'm looking for, like, a really small cap idea. But what about you?
So, all right, get ready for the eye rolling to begin, and also maybe a little bit of surprise. But something that I've just started to do, and I mean, like, in the past 2 weeks, I've done this half a dozen times, is go into, in my case, Chat GPT, but there's other products out there, and ask the simple question. You find a stock idea or a business idea that's interesting to you, and maybe there's a company in an industry. Ask who are the biggest competitors for that company. Like, here's one. I've talked a ton about Confluent, and I know the biggest competitors are Amazon, AWS, and Alphabet has a streaming product, or excuse me, not Alphabet, Microsoft Azure. They have a streaming product. That's probably the two biggest because of their streaming because of their cloud platforms, right? There's so many companies are putting data on those two that them having streaming products makes sense. But there are 10 or 15 companies that are really involved in data streaming at different levels, including IBM and other companies that are building on Apache Kafka, right? They're building their own product on top of it, and companies that have proprietary products. There's a massive amount of competition. And that sort of thing can be useful because using something like these LLMs, because it can quickly parse through massive amounts of data that you would take hours to really get through and still not find everything. And it can find far more than you would think about, far more than you would be able to give you the ideas about addressable markets and also who all are the players and the winners in doing these different things. So I'm beginning to use AI a lot more to do that because it can just do it really fast and save me time to actually really start digging in to where I think the opportunities are. So
yeah, I like the what are the competitors of this company I do know well strategy of finding other possible investments, because I think it
Right.
has two potential benefits. Like one is you find a new company that is a worthy investment, but the other is it might poke enough holes in your thesis that make you realize you don't own the right one in that industry. You could just use, not that this will happen with Confluent, but there's a scenario in which you research all those companies that came up from that AI search, Jason, and decide, you know what, Confluent doesn't have the advantage I thought it did, or it doesn't have the positioning that I thought it did. And then maybe that helps you. We talk all the time about it's easy to make a bull case for a stock you like, but the rubber hits the road when you start to develop the bear case and know what it is. And, so you don't fool yourself into holding on to something longer than you should, or adding to something that maybe you shouldn't. So yeah, that's an interesting, I guess the way I'd answer the question is, if I look for a fresh idea, I actually do search mostly. I want to find smaller companies. Like I do, if I ever use a screener, which is maybe twice a year when I'm just bored and looking for stuff, that's what I usually do is like, I'll put in a market cap below whatever, 2 billion or something like that. And I'll, put in other stuff that I would want to look for just to see like what's out there. The unfortunate part is it usually kicks back things I have no interest in buying, like, industrials and banks. It's a lot of industrials and banks. I keep hoping I'll come across some like cool software company that no one's heard of. But it's harder to do that now because so many of the great big companies that, would have come public 30 years ago at small market caps just don't anymore. They all stay private much, much longer. What did Amazon come to the market at? Less than $1 billion market cap, right?
Oh yeah, no, they raised a few $100 million in their IPO.
I mean, and that's different because it was so long ago, but like there really isn't an equivalent of that now. I mean,
no,
a big.
So there are plenty of companies that go public that only raise a few $100 million, but they're not
Amazon
coming out of Silicon Valley, right? No, that's exactly right. They're not coming out of those sectors where there's billions of dollars that's flowing into it. So that's exactly right. So so LDP, thinking about those stocks in your portfolio that you're still glacially holding to sell. Mentioned QuantumScape, still a believer, but it's just volatile. Simon brings up Wolfspeed. It's been a real dog, but I'm sticking with it. I want to talk about both of those really briefly before we announce the Investing Unscripted Options contest that we're going to be doing. Cena suggest no, we're not doing.
No, we're not doing that.
Love it, Cena. No, we're not doing that, but that's fantastic. So QuantumScape versus Wolfspeed. I want to say QuantumScape. This is a pre-revenue business, still trying to bring its product commercial, versus Wolfspeed, a commercial business that's been around for a long time, that's trying to become something different in the analog semiconductor space. You have one company that's been consistently hitting their goals at least over the past 2.5 years, consistently getting closer and closer to commercialization. Wolfspeed has faced a lot of struggle, high capital costs, and slow to add capacity and monetize the product that they're trying to bring to market for analog semiconductors in the face of a cyclical downturn, right? In the semiconductor industry, in the industrial side, that's kind of handcuffed the business. That's really made it hard for them. So you have one company that's executing and one company that's struggling, right? So looking at the two today, neither one the stocks are down a ton, over the past couple of years. Between the two, QuantumScape is the one that looks like the business is winning. Wolfspeed is still challenged. They're really, really challenged because of the cost to do what they're trying to do is going to be so high, which is interesting. You have a business that's actually selling stuff that's higher risk, in my view, than the business that still hasn't launched a commercial product. So that's the kind of stuff that AI can give you a bunch of buzzwords and spit out something that sounds interesting, but it can't yet reason in a way to like the craft of investing part of it, of really measuring the opportunity and the risk that we as investors. I could still be completely wrong, and QuantumScape falls another 99% in the next 2 years. And Wolfspeed, the cycle turns, it gets better, and they get some capital, and a bunch of companies decide to buy their semiconductors for the auto industry and those other high voltage applications, and goes on to great success. That's the joy of investing to me, is because you don't have to pick one either, right? You can allocate a little capital across these ideas, hold some safer stuff for when you do have the ideas that fail, and you get one or two of those high risk, high reward ideas that do pan out, and they make up for 20 bad decisions and still double on top of that, right?
Yeah. All right. We're at 5 o'clock here, so we're going to wrap up. The only thing I'll add to that is, in addition to using AI LLMs to maybe find competitors to stocks, it's also pretty good at explaining what a business does and dumbing it down for people like me who need that. So like when I find a software company that has a lot of business to business buzzwords, I'll put that into ChatGPT and say, explain this to me like I'm a 8th grader, and it'll give me a way to think about it that is helpful. So just one more AI tip as we wrap things up here.
Yeah, here we go. That's exactly right. All right. Well, we are definitely at the end of it right here. Thank you so much for everybody that was able to join us and interact. Thank you for the great ideas for stocks to do for our next Stocks Unscripted. We'll keep that list.
I got it. Wait, Jason, hold on. I almost forgot. So I think Simon was the closest with the outset medical guess. He had 65 euros, which if you translate it to dollars, it's about $70. And he's, I think, the closest. I'm not doing the math here, but the answer.
I guess what, 47?
You were close. It's $49.80 is if I sold my outset medical today, that would be my take home. And my original cost basis was $1,341. So
Price is Right rules, I win, right?
That's right. Jason's the winner, but yeah, I don't know. Someone,
what that makes you, Jeff?
What?
A loser.
Yeah, I know.
A loser.
All right. That's a good way to end it.
Yeah, you're not a loser. We're all winners here. All right. Again, thank you so much for everybody that joined in. Really appreciated the interaction, the engagement. For those of you that are listening to the recording, thank you for listening as well. Hopefully you can join us for one of the live streams when life gives you the opportunity and ability to do that. As always, I want to remind everybody that we love giving our answers to these hard questions about investing, life, AI, options, and the suckability of some of Jeff's investing decisions. But they're just our opinions, just our answers. You got to find your own answers. You can do it, people. I believe in you. All right. We'll see you next time, Jeff.
See you next time. Thanks, everybody.